This is your technical update from the LMAX Exchange Research and Analytics Desk for Tuesday, January 13th, 2015. Euro dollar. So the market remains under pressure, with the pair trading just off recent 9-year lows at 17.55. Although there is risk for a bit of a bounce with daily studies oversold, any rally should continue to be very well capped below the 50-day moving average in favor of fresh declines below 17.55 and towards the 2005 base at 116.40 further down. Sterling dollar. So cable is also correcting from oversold readings, with the market recently trading off of its 18-month lows that were set at 150.35. But overall, the downtrend remains firmly intact, and any rallies are expected to be very well capped in favor of a fresh downside extension below 50.35 and towards the 2013 base, which comes in at 148.15. Dollar yen. Dollar yen is comfortable consolidating in recent trade, with the market recently trading up to 7-year highs in December at 121.85. Ultimately, while the market holds above 115.55, the low that we saw on the 16th of December, the structure remains firmly intact, with only a break back below 115.50 to compromise the bullish structure. Euro Swiss. Euro Swiss continues to hover just above key psychological barriers at 120. The market looks like it could be trying to form some form of a longer term base, but it will need to break back above 2045 to help confirm this outlook. Inability to take out 2045 will keep the immediate pressure on the downside and leave the door open for a potential break of 120. Aussie dollar. Aussie dollar has been attempting a little bit of a recovery over the past several sessions, with the market trading out after stalling just shy of key psychological barriers at 80. Ultimately, the downtrend still remains firmly intact, and any rallies are classified as corrective, with a lower top sought out ahead of the next major downside extension below critical psychological barriers at 80 and then down towards the 75 area. Dollar CAD. Dollar CAD has been locked within a very well-defined uptrend, with the market surging now to fresh 5+ year highs and breaking towards the 120 barrier. However, daily studies are very overextended at current levels, with weekly and monthly studies also showing stretched. As such, there's risk for a bit of a pullback before we see a more continued bullish resumption, but any setbacks are ultimately seen very well supported ahead of some previous resistance in the 1670 to 1700 area. Kiwi dollar. This market has been locked within a bearish consolidation over the past several weeks, with any rallies seen very well capped up into the 78 to 79 area. Ultimately, a break below the recent 2014 low at 76.09 is favored, and that will open the door for the next downside extension towards the 72 area over the coming weeks and months. Back above 80.35 would be required to force a shift in the structure. S&P 500. There are signs that the S&P 500 is in the process of forming a major top after breaking to fresh record highs late December of 2014. A break below the recent low that we saw at 1990 from the 6th of January would help confirm, while below 1968, the low from the 16th of December would really strengthen the outlook for a top and open the door for an acceleration of declines. Gold. Gold continues to extend its recovery off of the multi-year lows, the 4-year lows that were established back in November at 11.31, with the market now trading closer to key resistance from the 21st of October at 12.56. A break and close above 12.56 would do a good job of confirming some form of a major base and open the door for an acceleration of gains. But inability to close back above 12.56 will keep the more medium-term pressure on the downside, with risk for a potential retest back towards the 11.31 low. That's all for today.